We're talking specifically about fuel price rises.
Yeah,
this is a problem for
right.
China, right? They've raised the price of gasoline and diesel.
Yeah, 6% and 7%. And, you know, it might have something to do with why the markets are looking pretty good today. This did not disrupt the markets. If anything, it probably sent a positive sign to global markets because it suggests that the Chinese feel that inflation is under control sufficiently that it can afford to put a bit of pricing pressure on their economy by raising fuel prices there, which they control. So 6.4% for gasoline, that's right, and 7% for diesel is a sign that inflation is probably under control. Maybe even they'll start stimulating the economy again. So that may have figured in a little bit to the positive vibe that we're getting in the markets over the last few days.
I mean, they feel they've got this buffer that they can play with. But interestingly, China itself raised its forecast to 4% inflation for this year from, I think it's trading around 3.2% last print, which is an interesting thing for them to be doing, projecting a higher inflation rate for this year.
Yeah.
And people are sort of talking about what this might be signaling in terms of some of their policies as well, right?
Wayne Ma from our Beijing Bureau has a good story on this on WSHA.com right now. That is down from 6.5% in July. So if you look at the trend lines, the trend lines were quite fearful last year. And there was concern that, look, they're going to have to do something. And if they really tighten up, maybe you get that hard landing as a result of concerns about inflation. It then dropped because of some tightening, and it was 3.2 roughly in the February read. And so they're saying, look, 4% for the year, which would be down from last year and manageable. And they seem to be relatively on track for that. I mean, it's early in the year, but they seem to be relatively on track. And so there's a kind of a slight kind of relief of concern that China was going to have an inflation issue this year.
There's also this view, though, that by sort of allowing themselves a little bit more leeway on inflation, they may be thinking about reflating the economy internally rather than through the currency, right? There's this idea that at the end of the day, if you have an underappreciated currency, which many people believe China still has, then you get back into equilibrium with the rest of the world, either by raising prices internally or by having your exchange rate rise. And China, of course, is very slowly letting the appreciation. So some people have actually taken this to be a signal that, well, now we're going to go for the internal reflation and appreciation rather than the currency.
And if not some kind of reflationary moves, then perhaps just a little bit less stringent control over what they call administrative matters, which is telling banks not to lend as much because they were concerned about overinvestment in some of the provinces. And these go in cycles, right? I mean, we've seen this repeatedly in China where they'll kind of incrementally increase the reserve ratios for banks, saying you got to keep more money on hand. Primarily that means just don't lend it out because we got a housing bubble or we have an asset bubble of one sort or another. And they had been doing that over the last couple of years, and there have been other measures to kind of crimp the economy, to slow it down a little bit.
It's an incredible process of micromanagement, though, which is interesting. We look upon China with envy and some people with admiration, and yet here is an economy that is being managed in a way that runs counter to a way that sort of orthodox economists would tell us to do so. They manage the fuel price, which is what we're talking about here. They manage interest rates. They manage how much banks can loan. They manage their exchange rate. It's an incredibly interventionist model. And this is a big concern for the notion that can they actually keep this model in place as they go through a transition to a consumer society.
It's extraordinary, isn't it, that they have been able to manage this with 1.4 billion people as delicately as they have, right through a huge economic shock that we experienced here. We probably had a greater negative impact on our economy. There will be seers who say China's payback is yet to come, right, because it's facing demographic problems and other issues. But the micromanaging does seem to have been done quite deftly up until now. But the signals, even within this fuel announcement, that as kind of incremental in the news as it is, that China is seeking as fast as it feels comfortable going to market rates. It says that, for example, it's going to be testing in some provinces, letting the market determine natural gas rates as opposed to the government. So it wants to shift over. It doesn't want to be in the business of having to manage every, because then what it does on the back end of that, concerned about certain sectors like food production sectors, it's providing fuel subsidies still. So there's an immensely inefficient process.
It's a big balancing act, and the world has a big interest in them being able to pull this off.